Bristol-Myers is looking significantly undervalued at its 52-week lows, and it is offering a yield of nearly 5%. So let's take a look, see why it is so heavily undervalued. We're going to run through the performance of the company. We're going to take a look at their income statement, how their top line revenue as well as bottom line net income has been progressing. We'll look at the company's health check based on their latest quarterly earnings, their total cash versus their total debt. We'll also analyze the industry as a whole, their performance over the last 5 years. We'll look at the dividend safety and show those financial metrics and come to our conclusions on this company. We'll also take a look at the institutions, are they buying or selling, as well as looking at insider selling and insider buying, which is very important. And we'll touch upon a few points that is discussed within this article about the patent issues that Bristol-Myers are facing. And as always, we will run them through our valuation model, getting to the intrinsic value as well as the acceptable buy price, given our investor margin of safety. So let's take a look at Bristol-Myers Squibb company. As we can see, over the last year, they are essentially down around 30%. Now that is huge, that is significant, and we can see the forward PE is now below 7. And over the last 10 years, this company is down 8%, although this does include, or in fact excludes, the dividends reinvested. That is very poor, and we see its all-time high at around $81 at the back end of 2022. So let's take a look at their essential income statement, their top line revenue as well as their bottom line net income. Now 3 to 7% is what we're looking for here year on year. 22.5 billion reported in 2018, 46 billion reported in 2022. Now the 2023 annual report hasn't been delivered yet, but we are expecting a drop to around 45 billion from that previous year of 46. So a few things to note. We can see the consistent increases from 18 to 19, a huge jump to 2020, and then we see pretty much a very nice increase to 21 before remaining flat in 22, and then a small decrease. So top line is increasing over the last 5 years, but it is important to note those inconsistencies, and we'll touch upon those patents and products shortly. Net income then, 5 billion reported in 2018, 6.3 billion in 2022, and expected to go even higher in 2023, even though the top line is expected to fall from 2022. On a more granular level, we actually see the bottom line decrease to 2020 before picking up and then dropping again. So there are inconsistencies to note on the income statement, both top line and bottom line, but on a more positive note, they are increasing over the 5-year period. Now, total cash versus total debt, a quick health check of the company. 8.8 billion cash in 2018, 7.7 in their latest quarterly report. So they are holding slightly less cash than they did 5 years ago. And when we compare that numerically and directionally to the total debt, we can see total debt has increased astronomically from 7.4 billion to 39 billion. So let's take a look at that when we do analyze those financial metrics and the net debt to EBITDA. Now the industry, we're taking a look at the pharmaceuticals. We have competitors such as Zoetis, GSK, Merck, as well as a few others. Now over the last year, we can see BMY, this includes those dividends reinvested, the worst performing at negative 27%. Although do note the majority of the companies in this industry haven't had a good year, with only 2 of them returning positive returns over the period. Over the last 5 years then, BMI is up around 24%, as we can see here. Again, one of the worst performing in the industry. Something to consider, but it doesn't necessarily mean that this is an indicator of future performance. Now, institutional ownership, 75%, as we can see here. 9.3 billion worth of institutional outflows over the last 12 months, with a significant amount more of inflows, 54 billion over the same period. So institutions are liking this company. They are buying a lot more than they are selling. In fact, the largest buy came in Q2, although we do note a little bit more selling in Q3 than or essentially more selling than buying. But again, this is just something to take account of. It isn't something you should base your own investment decisions on. Now, institutional ownership was what we saw now, but now let's take a look at insider ownership. 0.09%, so they don't really hold that much of the company. But one thing that's interesting to note is 23 million worth of insider selling over the last 12 months. But more importantly, we're looking at the insider buying to really give us a good sense of the company and management, whether or not they have long-term faith in the company. There are many reasons why insiders may sell, but the only real reason why insiders may buy is that they do have faith that right now that share price is a lot lower than what they believe it to be. And that is one of the things that is taught in Peter Lynch's great book, One Up on Wall Street. So let's take a look at the institutional, or in fact the insider buying. So what we can see here in Q4, we see that the CEO bought 28th of November, so only a few weeks ago, around 3,000 shares, so around 150,000. Now that's not a lot, but it is quite important to note, as well as we see the director here, in fact again not too far off, 20th of November, buying around 8,500 shares for around 400,000. So both the CEO and director have bought shares. Now it isn't a huge amount in relation to probably how much they do hold, but we do see they were buying not too far off the current trading price. And that is, in my opinion, a bullish signal. But as always, we're not going to copy what they do. We always need to do our own due diligence. Now, before we do jump into the financial metrics and the valuation, let's very quickly take a look at this article from the Motley Fool from December the 15th, so not too far away. And a lot of it does still hold true. Now, they talk about the patent issues that Bristol-Myers face, but also about the new medicine that the company are not only bringing in, but is starting to take up a lot more of their revenue, which is positive to see. Now, we can jump straight into the important parts here. They just discuss the issues that they faced, the drop in the share price around 30%. Now, this is what we want to focus on, the recent results. Now, we know they're not great, but they should improve. So let's jump straight into this information. Now, the first thing to highlight here is that Bristol-Myers' cancer therapy, Revlimid, lost its patent exclusivity last year, which essentially means now that other companies in the industry can sell this product, whereas before Bristol-Myers had exclusivity, it was only them who sold this product. And we can see, which was a bit of a shame, it was their best-selling product, so now there will be a lot more suppliers of this medicine. What we can see then, because of this exclusivity loss, their sales from that particular product declined by 41% year on year. Not the greatest, but as we can see here, that single drug still accounts for a lot of the company's revenue, and given that it has dropped, it is a bit of an issue that we have seen, especially when we took a look at their income statement, and we did see their top line expecting to drop by around 2 billion. So what we are expecting is older medicines, as we can see here, growing in sales. That is one of the things that Bristol-Myers are hoping for. But on top of that, we also see that Bristol-Myers' portfolio of brand new medicines were approved in 2019. Now, whilst, as it mentions, it doesn't make up a lot of the company's revenue at the moment, they are expecting this to grow year on year. And we can see that over the more recent period, this has gone up around 68%. Now, yes, this isn't something that will happen straight away, as it does mention, but they are expecting by 2030 that this new element, this new revenue from these products will make up around 25 billion worth of their sales, which is more than half of what they currently report year on year. So there are positives to note here, but there are also some things just to consider in line with their patent exclusivity being lost on that product. So let's jump into dividend safety. Score of 70, it is safe. 100 billion market cap, a mega cap company. Now, in terms of the recessionary metrics, they maintained the dividend during the last recession. Below average growth, minus 21% versus the S&P's negative 12, but they outperformed the S&P, negative 32 to negative 55. Dividend growth, not too bad. They actually increased the dividend just a few weeks ago, 5.3%. So you are getting an increase above that 4% inflation that we always advocate, as well as a fairly decent starting yield of just under 5%. And over the last 5 years, a 7% increase on average is positive. Last 20 years, 3%, not the greatest. Now, in terms of dividend growth streaks, they have been increasing those dividends for the last 16 years. Whilst paying a dividend for 52 years without a reduction. Now, dividend yield theory states the company is undervalued when the current yield sits above the 5-year average. So we have a sign here of severe undervaluation, 4.77 versus 3.15. But as we always say, we don't look at any of these models in isolation and we'll draw our conclusions towards the end of the episode. Forward PE significantly lower as well, 6.6 versus the 5-year average of 9.1. So we have two signs here of extreme undervaluation. Now, sector PE, healthcare is sitting at a much higher 18.3 versus the 6.6. Now, free cash flow payout, as always, do focus on this. It is very important to understand how the earnings is susceptible to manipulation by management through accounting. 2015, 193. 2015, 74%. This is showing here that in 2015, 193% of dividends paid in relation to that free cash flow. So management are paying out more in dividends than the company is generating in free cash flow. Huge red flag. But from that point, it has come down. 2023 expected 42%. So that is positive to note. That dividend should continue to grow at a fairly decent rate above inflation. 183 on the free cash flow per share, 561 in 2022, expected slightly lower in 2023. So it has increased over the period. There are some inconsistencies to note, but over the longer term, it is moving in the right direction. Sales growth, steady moderate growth of 3 to 7% is what we target. 2020, some strong growth. 2021 again, but the last 2 years, 0% in 2022, negative 4% in 2023 is a slight worry there. But if you understand the reasons why, then you can make your own reasons and judgments as to whether or not you believe it will start to continue grow as it was before. And as we did read in that article, they are expecting some strong growth from their new products from 2019 that they haven't yet felt the full effects of. 16 billion to the top line in 2013, 46 billion in 2022. So again, it is growing, not inconsistently in fact, but it is still growing very rapidly over the last 10 years. ROIC, remember 10% or more, gives us faith that management are able to effectively allocate their capital. Now, very mixed, although the last 3 years above 10% is very positive to me. It does give me faith in management, as that is one part of the investing process. Operating margin, really inconsistent, not what I'd like to see. I want to see 25% or more for biotechs. The last 3 years they have been struggling. It is something that I would keep an eye on moving forwards. You don't want this to start slipping. You want to bring it back up to around 25%. Free cash flow margin over the last 7 years, very positive, 20% to 33%. So that is something that we do like to see as investors. And finally, the net debt to EBITDA, earnings before interest, tax, depreciation, and amortization, showing us two things, that dividend safety as well as the balance sheet strength. 1.55, signaling the number of years it would take the company to pay off all of their debt net of cash on hand. 1.72 expected in 2023's report. So it is on the border, something to consider, but so far the dividend does look safe, but there are a few points that you should consider as an investor moving forwards. Now let's jump into the valuation. As always, if you're enjoying the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now let's jump into the valuation process, and don't forget you can click on the pinned comment below to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or those on your watch list. Now let's get into the first model, which is Graham's valuation. We have the stock ticker symbol, earnings per share, growth rate, corporate yield on AAA corporate bonds. Now we see here intrinsic value $71, market value 50, so undervaluation signal number 1. But as always, we're not looking at any of these models in isolation and we'll draw conclusions towards the end. We then have some companies in a similar sector and size. We have their P multiples, the average, multiplied by the earnings per share of BMY to get an intrinsic value of $86. Again, another signal of undervaluation. We then move on to the dividend discount model, some nice increases year on year. Forward looking, gone a lot more conservative. As always, if you grab a copy of the model, you can play around with these numbers based on your own estimates and judgments. Another sign here of undervaluation. The fourth model, we have the DCF model with the free cash flows year on year. Now we've gone incredibly conservative here with our estimation at 0%. Analysts are expecting an increase, but to be on the more conservative side, we've gone for 0. In accordance with that discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value. Shares outstanding, $76 for the intrinsic value, our fourth and final signal of undervaluation. As always, then the intrinsic value is just the average of these four models. And for today's episode of BMY, it comes to $73. Now, margin of safety, for those that are new, we start off with 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. So it is a buy up to $66. At 15%, a buy up to $62. At 20%, a buy up to $58. At 25%, it's still showing a buy, so this has some significant undervaluation. Margin of safety then 30% on BMY. Will be interesting to know whether or not you are looking for a much higher margin of safety, but for me, around 30%, this does look like a fairly strong buy. In terms of Wall Street and what they forecast over the next 12 months, well, they see around 26% upside, with the price going to around $63, $64. Now, this is one that I do believe to be incredibly attractive to buy as an investor, but again, it does come down to your risks, whether or not you believe the exclusivity loss and the patents is a very large drop for the company and that they won't be able to justify or sustain those high increases they had with their new products that are coming into flow, and that they do believe will return the company to the increases they did see in prior years. As always, let me know your thoughts in the comments below. If you enjoyed the content, smash the like button, hit the subscribe button. Catch you all on the next episode, and take care.